You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Thanks for tuning into this week's episode of the Tax Smart REI podcast. Today we're back with another Q&A episode, and we'll be taking questions from our Tax Smart investors community, including things on short-term rentals, QBI deductions, the 14-day rule, and a lot more. So stay tuned. We'll be diving into all of that in just 1 minute. Are you ready for the 2025 tax changes under the new administration? With new leadership in Washington, the tax landscape is shifting fast. These are some of the biggest updates we've seen in years, and if you're not proactive, you could be leaving thousands on the table. But don't stress, we've got exactly what you need. Access our exclusive 2025 tax changes resource, an in-depth tracker that breaks down what's new, what's changing, and the strategies that you need to stay ahead. This isn't just some generic checklist. It's a powerful and live resource tailored for real estate investors like you. Head on over to www.therealestatecpa.com/2025 tax changes to access this essential resource. You'll get immediate insights into how to navigate the new administration's tax policies and how to keep more of your money in your pocket. That's www.therealestatecpa.com/2025 tax changes, because smart investors don't just make money, they know how to keep it. We'll see you over there, but right now we'll jump right into today's episode. All right, and we're back. Okay, so the first question that we have today is, will active losses from our short-term rental carry over to the next year, or must it offset active income in the same tax year? So, long story short, when you have a short-term rental and you qualify for the short-term rental loophole, so you have 7 days or less on average for the year, and you materially participate, the losses will be active in that current year. Okay, so that means it'll offset whatever income you have in that current year. And then if your total losses exceed your taxable income, meaning it completely wipes out all of your income and you still have losses left over, then it will carry forward to the next year as a net operating loss, also known as an NOL. That is how that works. But just note that it will have to first offset the current year's income.
So the next question is, they've got a few rental properties out of state. Takes about 3 hours to drive each way. Usually go there to check on this twice a month. 6 hours of driving and about 2 to 3 hours time spent on altogether. Will that be considered material participation or total hours for reps? In general, no. Anytime we have travel time, we don't want to consider that. It's just risky. There are really slim circumstances where that could be considered time towards material participation, but we generally just say no, just to be safe, because almost all the time it's going to be excluded, and we wouldn't want you to rely upon that time that you have traveling to be included to meet material participation. Just too much risk from our opinion, and almost every time we've seen this in a court case, they do throw it out. That's kind of the short answer there.
Yes, but just to clarify here too, because I know what a lot of people ask after that is going to be, can you deduct these miles? And yes, if you're driving from your home office to your rental property, or you're driving outside of your tax home, you could generally deduct the miles, or they'll count as business miles if you're going to use the actual expense method and you're looking to use like bonus depreciation on your vehicle. The miles will count as business miles, but the time does not count. Like Ryan said, it's been pretty clear from the tax courts and the IRS what their stance on that is. You could say it's fair, not fair, doesn't matter. That's what it is. Next question we had in here was, do you know a good CPA who's familiar with the short-term rental loophole? I wonder. Yeah, I mean, look, if you're a long-time listener to the show, you know that we practically invented the short-term rental loophole. We brought it out, shined a big light on it. We've helped hundreds of investors at this point save significant amounts of money on taxes and navigate the intricacies of this to a degree that probably no one else has. Just to be honest, we have a book on it, Short-Term Rental Tax Secrets. You can get that on Amazon for like $1. We have an entire podcast series on it, the STR series, where we go in depth on it right here on the Tax Smart REI podcast. So you can go ahead and check that out. But if you do want someone to walk you through it, hold your hand, make sure you're not making any critical mistakes. It's optimized for your specific circumstances, or your questions answered, and you can move forward with confidence knowing you're doing everything right. Check out the link in the show notes. You can request a free discovery call where we'll see if we're a good fit to work together. And if so, we'd love to help you navigate your short-term rental journey. So thanks for whoever asked that question. Appreciate it. But we got another one. We got another question. For the QBID deduction, which is the qualified business income deduction, there is a safe harbor, the rental harbor safe harbor for 250 hours. The question is, can you group multiple K1s on your 1040 so you can basically group them all towards that 250 requirement?
So I believe the short answer is yes. Correct me if I'm wrong, Tom, if you know otherwise, but I believe the short answer is yes. When it comes to this rental real estate safe harbor for qualified business income deduction, for whatever reason, it seems to come up like quite often. As someone who has done a lot of tax filing in the past and still is preparing like my own tax return, I've just never had to use that. Like it's there. I can't even remember all of the reasons that they put that in place, but for the most part, most of you listening to this are not going to need that. For the most part, rental real estate as a business is going to be QBI income, and therefore it's a little bit unnecessary to need to use the safe harbor. Oftentimes when it comes to like QBI and the 199A deduction, it's oftentimes a matter of, is it truly a trade or business, which gets into section 162. That would be an issue for more like triple net leases. Or I think the other one is, Tom, remind me about this because we haven't talked about this in a long time, is also if you are like renting a property that you also use like for your own primary residence. I think that's the only like nuance there. But for the most part, you aren't going to need that. But to answer the question directly, I believe the answer is yes, you can group those together.
Yeah, you can group them together as long as they're all residential or all commercial. You cannot mix the two. And the safe harbor was just put there to, when they originally did these rules, there's a lot of questions on whether or not rental businesses do rise to that level of a 162 trade or business, which is just tax jargon for a business. And some people argue it's not, it is, it isn't. So 250 hour safe harbor across all your rentals that you have in that grouping will make it a non-issue. Best part about this 250 hours, you don't even have to do the 250 hours. Anybody can do the 250 hours. So you have agents of you, employees, staff, your partner, somebody has to do them, right? So QBI deduction for real estate investors, not often too big of a deal anyway, but 250 hours, you'll be safe. Okay, that's why they call it a safe harbor. Now we have another question. I occupy my primary residence and short-term rent it occasionally. Midway through the year, I convert my primary residence into a short-term rental full-time. I manage it 100 plus hours, average of 7 days or less, et cetera, et cetera. So they meet the short-term rental loophole after they place in the service for the year. So when you have a primary residence and you rent it out occasionally to short-term rental, you are running into the residency issues. So if you have a residence and you rent it out for 14 days or less, you do not need to report it at all on your tax returns. Now, if you're renting it out as a short-term rental, your entire house, like say you're going on vacation, it's more than 14 days, it will be reported on your tax return. You have to report the income, the expenses, but the losses will be limited to your income, right? So you cannot create a loss in these circumstances. However, I'm just trying to break this all down for everybody. If you have a primary residence, you rent out a room exclusively or part of that primary residence exclusively as a short-term rental, and you don't use it personally, then that's considered a short-term rental itself, okay, to be clear. But if you're renting out your entire home, that's when, that 14-day rule comes in. We'll get more to that. There's another question on the 14-day rule. But usually when you move out of your house and you place it into service as a full-time rental, then that's usually when that rental period starts. So you should, Ryan, I'd love to get your take on this one too, because these are always puzzles we have to put together here. If you move out of your place, you make it a full-time rental unit. From that point on, the day you place into service, then it's fully a rental. And therefore, in your case, you met the requirements. You should be able to use it as a short-term rental for that after moving out. With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode.
The tough part here with that one is you are using it as a mix in the first part of the year. So let's say like the first half of the year, you're there for 75% of the time, and then you rent it out, I don't know, on the weekends or something. Maybe you go visit some family or something. So basically, you have to still show personal versus rental. Over time, like over the course of that year, then if it's all rental after that, you've still got all those personal days in the first part of the year. So it is kind of a complex amount, and you will need to be careful, like Tom said, of like the residency rules where you're going above that 14-day test or 10%. It's going to probably, I would guess, limit your ability to take losses would be my guess.
This is one of those ones where you have to be careful. You might be getting too cute here. If it was simply your residence, you moved out, you started renting it out as a short-term rental,
That's clear.
that makes a very clear,
Yeah.
very clean case for you, right? In this case, you're renting out your residence while you're living there as a short-term rental, and then midway through the year, you're converting it. You're adding a lot of mud to the water. You're adding a lot of dirt in the water, making it muddy. And, whether or not there's a case to do it here, there might be, right? We'd have to take a deeper look into the details to give you a very clear answer on this. But I think you might be getting too cute. And if you were audited, trying to piece this together with the IRS, even with a good CPA, could be challenging. So what I would suggest is speaking with a tax advisor specifically for your situation where they can get all the details and then properly advise you and help you navigate it. Because what we're seeing right here, just with the limited information that we have, it's an iffy situation. And like I said, I would speak to a tax advisor about your specific question here.
Sure.
Next one we have, if you take bonus depreciation on a short-term rental, what tax implications do you have if you later sell the property? So look, before I answer this question, I want to say something here. We're not all about short-term rentals on this show, right? What's happening though is that short-term rentals are still one of the most popular investment strategies. So we're still getting a substantial amount of questions, a substantial amount of clients and potential clients coming to us for help with short-term rentals, okay? There are still plenty of other viable strategies. We just interviewed Jesse Vasquez not too long ago, a few episodes back, on midterm rentals. Not too surprisingly, but it's a very viable strategy. Could have strong cash flow, so go check that out. We're going to be interviewing another gentleman here on more long-term rentals and traditional investing. All these strategies still work, but short-term rentals still remain a very popular strategy, and that's just why we're having so many questions. For anybody out there listening, or the Tax Smart REI podcast just become a short-term rental show? No. To some degree, we have to pay attention to what people are coming to us for and help them with what they need help with, right? But we're not a short-term rental show. I can promise you that. But anyway, to answer this question, if you take bonus depreciation, do you have to pay a penalty or add that back later on, right? What they're talking about is depreciation recapture. And depreciation recapture applies to long-term, midterm, and short-term rentals, right? If you take depreciation, which you have to take depreciation on a rental property, you have to. The IRS requires it. If you don't take it, they assume you did anyway, and they're going to charge you depreciation recapture taxes. So here's how it works. When you buy a rental property, you're going to start depreciating it. Every year, you're going to have your depreciation expense called accumulated depreciation. And for short-term rentals, they depreciate over 39 years. This is called unrecaptured, right? I'm going to get some technical jargon here. Unrecaptured 1250 gain, okay? Straight line depreciation. This type of depreciation recapture, when you sell, is taxed at a rate up to 25%. Then you have accelerated depreciation. This is, for most of the people listening here, going to be bonus depreciation. When you take bonus depreciation, again, whether it's a short-term, midterm, or long-term rental, okay, that's going to be subject to recapture at ordinary income tax rates up to 37%. So to answer your question, when you sell your property, a portion of the gain, assuming you have a gain, you sell it for more than you bought it for or more than your adjusted basis, then you're going to have to pay depreciation recapture taxes. It's just the way it works. So there's a few things you want to do here. A, you want to make sure you're in real estate for the long term, decades, if not perhaps your entire life, so that you're playing the long game, not just trying to use this as a little tool 1 year to reduce your taxes, although maybe that is strategic in limited circumstances, but oftentimes it makes more sense to take real estate and look at it as a long-term investment, a long-term game that you're playing to build wealth over your lifetime. And if you look at it that way, you can use strategies like the 1031 exchange to defer this tax when you sell. You can maybe use the lazy 1031 exchange, which is using passive losses to offset this. And hopefully 100% bonus depreciation does make its way back to us, and you can go ahead and use that. So we'll see how that all works out. That's about that. Long story short, when you sell, you have to pay depreciation recapture unless you use a strategy to defer it. Next question, Ron, you want to take that one?
Yeah, this one's actually about the home improvements you make on your personal primary residence.
Hey, tax smart investors, real quick, just wanted to remind you that I do have a YouTube channel that I'll be posting on relatively consistently this year, covering tax strategies, tax tips, and tax news for real estate investors and business owners within that 7 to 12 minute range. So if you do like that shorter form, hard hitting content, you can go ahead and find me at www.youtube.com/@ThomasCastelli, or simply by searching Thomas Castelli CPA on YouTube. Subscribe to the channel and drop me a comment what video you want to see next, and that just might be my next video. I'll see you there, but for now, we'll dive right back into today's episode.
And the question is, do I have to submit the improvements every year in my tax return, or just keep the receipts and submit them when I sell the house to increase my basis? So yeah, bottom line, you're not submitting anything for a personal residence, whether it's throughout the time that you own it and make improvements or when you sell. Do not submit anything to the IRS as far as receipts or invoices. Please, you're never doing that. You're just keeping that as documentation. Yes, it is something you do want to keep track of because, for example, let's say you bought a house for $500,000. Let's say then you make $100,000 of improvements. You've now got a cost basis of $600,000. Okay. If you sell that property for, I'm trying to use kind of my numbers here to make it so it actually does have an impact. Let's say you sell it for $900,000 and you're married, no capital gain. Okay, because if you're married filing joint, you get the $500,000 capital gain exclusion under section 121. You're fine. It is good to keep track of that because if you're in a different situation where let's say you sell that house, like it's increased significantly and you actually sell that property for $1.2 million. Okay, now you've got $600,000 of gain. You can wipe out the first five. You're paying tax on $100,000. Okay, 1.2 minus 5 minus the 6 as far as basis. That's going to give you $100,000. If you never took advantage and never recorded all those $100,000 of improvements, now your capital gain just got doubled because now it's $200,000 of gain instead of $100,000. Okay. So because we kept track of that $100,000 of improvements throughout the year, that increased our basis and therefore decreased the gain that we had. So that is important. It's nothing you do on an annual basis. It is something to keep track of. I usually just recommend put it in a spreadsheet, a Google Doc, something like that, so that at the end of the time that you go to sell it, you're basically having a really clear picture of your true cost basis.
Awesome. So yeah, you definitely need to keep those when you sell. You don't want to lose track of those because you want that to help you reduce potential capital gains taxes down the line. So this is the last question we're going to be taking for this episode. And I kind of got a little ahead of myself before with this one, the 14-day rule. But I get actually a lot of questions on this, actually quite common. Can you explain the 14-day rule? Do I need to rent my home for 14 days or less in order to use the short-term rental loophole? Okay, so here's how it works. And I kind of explained this a little bit before. If you live in a property for more than 14 days, so 15 days or more, that becomes a residence. And when you have a residence, if you do rent out your residence, you are limited in many cases to the deductions you can take, right? You can only take expenses to the extent of your income. So that's just kind of the first thing to know. Also, if you rent your property for 14 days or less, okay, and it's your residence, to be clear, so you live in it for more than 14 days, and then you rent it for 14 days or less, right? So it's a residence, then you don't have to report the rental income or loss. You rent it for more than 14 days or the greater of 10% of the days rented, which I've never actually seen many people use. But then in that case, you do have to report the income and the expenses on your tax return, but they're limited, right? Okay, you can't take a loss. So that's the issue. Now, the next question we often get around the 14-day rule and where the confusion comes in is, do I need to rent my home? If you buy a rental property, you buy a property and you rent it for, let's say, 10 days, right? 2 stays of, one stay is 6 days, next day is 4 days, and you rent it for a total of 10 days. Can you still deduct the income? Do you still have to report the income and deduct the expenses, and can you take a loss? The answer to that question is yes. And the reason for that is because this is not a residence. Okay, so the 14-day rule mainly applies to residences in that A, just to recap, if you live in the property for more than 14 days, it's a residence. If it's a residence and you rent it for less than 14 days or 14 days or less, then the income and expenses are not reported in your tax return. So it's free rental, right? That's the Augusta rule. Okay, then we're not going to get too deep into that right now. But then the 14 days or less of renting it, right? This does not apply if it's not a residence. So if it's just a pure rental property, you don't use it personally, okay, then you're good to go. So that's in a nutshell how it works. Now, if you do have questions, do you want answers to those questions, we'd like to invite you to our Tax Smart Investors community on Facebook. You can just go and search for Tax Smart Investors on Facebook and we'll come right up. You can join the group. As long as you're real, you're not a bot, we'll let you in. and you can ask your questions, and someone either myself or someone will get back to you with an answer. But we'd love to take your questions, or we might just answer it on the next episode of this live Q&A. Also, if you just do want to work with somebody one-on-one, just to get really shorten the learning curve, get really clear on what you need to do to reduce your taxes and avoid critical mistakes, make sure you're not missing out on opportunities, and you just have a very clear handle on what's going on, we'd love to learn more about your situation, how we can help. You can request a free 30-minute discovery call with our team at www.therealestatecpa.com/podcast or by clicking the link in the show notes below this episode. But that will be all for today. I'm looking forward to seeing you guys on the next episode. And who knows, your question might be answered here on the next one. So see you soon.